Hello, everyone. This time we will discuss a book called The Intelligent Investor by Benjamin Graham. This book is very popular, and I recommend it for a beginner who wants to enter the world of capital markets, especially as an investor. Introduction. The purpose of the book. Benjamin Graham's initial writing in this book is to discuss the purpose of writing a book entitled The Intelligent Investor. Graham says that it is very important for ordinary people to learn and find a tutor who can guide them in adopting and executing an investment policy, especially in terms of the most basic investment principles, behavior, and psychology of investors in the capital market. So this book emphasizes on these three aspects and does not talk too much about securities analysis techniques, like most other books. This book is intended by Graham for people who want to become investors and not market speculators. Graham insists that his first task is to inform ordinary people about the difference in the meaning of the two terms. Not everyone who enters the capital market can be said to be an investor, because the term is only worth mentioning after we know one's preferences in making investments. By considering and knowing the various things that will be discussed in the next chapter, and following all the instructions given, the person will indirectly be called an investor instead of a speculator. This is important because this is what the book was originally written for. Graham says that the book is not written to explain how to become a millionaire because there is no definite path to wealth on Wall Street. But this book is written to make the reader a smart investor. Since this book is not intended for speculators, it may not be suitable for those of you who want to become traders, who seek profits by relying on chart information or other mechanical devices to determine when it is appropriate to sell and buy a security. Later, Graham also explains the difference between defensive and aggressive investors. Defensive investors are people who run their investments by prioritizing the avoidance of serious mistakes or large losses in the capital market. Defensive investors tend to prioritize comfort in investing, so that even though they invest in the capital market, they can be free from hard work, distractions, and having to make tiring and repetitive decisions. In contrast to defensive investors, aggressive investors tend to be willing to sacrifice and devote most of their time and attention to carefully selecting the securities that are more likely to promise them profits. So, in short, the difference between the two lies in how they prefer the investments they take. As the investment rule of thumb says, the higher the risk, the higher the return. So, to distinguish which category you fall into, you simply need to ask yourself how often you increase the risk of losing your time by scrutinizing potential future securities. However, for aggressive investors, it is important to be aware of the investment traps that often arise in forecasting future returns. We know that the first thing to do in forecasting the future of Wall Street is to choose which industry sectors have a greater chance of growing in the future. And several times in history we have proven that this tends to take us in different directions. For example, stocks in the airline industry were very popular with most investors in the 1940s. All investors at the time predicted that the industry would soar as air traffic would become more congested in the future. But what happened was beyond everyone's imagination. Instead of making a profit, the shareholders had to bear losses that reached $200 million due to the losses suffered by the group of airline companies. And not only in the airline industry. A similar example occurred in the internet-based company industry, which experienced boom and then dropped everyone's expectations. In this case, Graham argues that the only thing that rising stocks lead to is their decline. In this discussion of the introduction, Graham tells us at least three things. 1. Set your own vision. If you are interested in being a speculator, then stop reading. If you are interested in being an investor, then determine your preference whether to be a defensive investor or an aggressive investor. 2. Be a smart investor who succeeds in increasing your knowledge of investing, restraining your emotions, and refusing to follow the market's level of madness. 3. Beware the pitfalls. The downfall of the airline and computer industries is a clear example of the pitfalls of future forecasting. It may seem at first glance that the basis of judgment is to use appropriate analysis and be carried out by professionals, but that is precisely what makes everyone think the same, and that is also what causes the analysis and forecast to deviate. In the next discussion, Chapter 1, we will discuss investment versus speculation.